In a normal environment, raising interest rates will drop prices because the amount that you can qualify for will go down. There's a lot of scenarios right now where it shows, in fact, that interest rates going up are not going to crash the market. They may slow down the market, but it's likely not to crash the real estate market. And here's why. Hey, what's going on, cash flow hackers? It's Chris with Life 180. And for this video, we're going to be talking about the real estate market, interest rates. Are we in for a 2022 correction, crash, however you want to phrase it? And ultimately, you know, there's been a lot of speculation, a lot of news articles, a lot of media stories regarding the fact that interest rates are going up. And I myself have spoken a lot about the fact that, houses are really only worth what people can afford to pay, right? Like that, the house is not worth $500,000. The house is worth a $3,000 a month mortgage payment, right? Like that's typically how it works out. And so in this video, I'm actually going to go through some scenarios in which potentially the traditional issues and traditional principles with finance and with house prices could be turned on its head, and I want to get into why. So I guess jumping right into this, let's talk about the fact that interest rates right now are creeping up to 4%. Actually, the last couple days at the time I'm filming this video, they dropped back below 4% a little bit. There was a pullback with the Ukrainian war. I think lenders are dropping rates just to kind of help stimulate the market a little bit, hoping to get a little bump. But the bottom line is interest rates are coming up. And so we are running into a scenario where people are concerned that the government is going to raise interest rates, right? So as the federal fund rate raises, typically the 10-year bonds will raise, and mortgage rates are typically tied more to the 10-year bond market than they are the federal funds rate, right? So that's important to understand. Now, when we look at what's going on in the world, and we look at the inflation market, and we look at the inflationary environment that we're living in, inflation right now is at 7.5%. So this is one of the things that I started looking at, and I think it's really important to kind of wrap our head around, is the fact that in a normal environment, raising interest rates will drop prices because the amount that you can qualify for will go down. There's a lot of scenarios right now where it shows, in fact, that interest rates going up are not going to crash the market. They may slow down the market, but it's likely not to crash the real estate market. And here's why. So when we look at inflation, right now at 7.5% inflation, if you go back in history and just if you understand, actually, before I go there, I gotta tell you how inflation happens and how inflation is built into our economy. So it's important to understand that inflation is baked into our economy, right? You really have to understand that. With Keynesian economics, with a fractional reserve currency system, and utilizing the fiat money system as we do with Keynesian economics, the federal banks have the ability to raise interest rates or lower interest rates depending on the economic environment. So the overall theory is that when inflation gets high, the economy will be booming. Therefore, the banks can reduce interest rates and take money out of the economy. So when they take money out of the economy, then that makes it so inflation comes down. And then on the flip side of that, if we're going through a recession, assuming interest rates are at a normal level, which was always the assumption based on the Keynesian economic theory, that if we're in a depressed environment, not necessarily depression, but a depressed environment, an underperforming environment, the federal banks, the Federal Reserve, could reduce the federal funds rate. They could stimulate the market, and that would put more money into circulation because the cost of borrowing would go down. That would allow prices to come up, or make things cheaper, I should say, which would make it so people are, it's easier for them, takes less stress off them. That will stimulate the economy, and that will help level off all the peaks and the valleys, right? Now, I don't know about you, but if you look at the market, we've had this Keynesian economic theory with the Federal Reserve since 1913. they haven't done a great job at curbing the peaks and the valleys. But I digress. So where we are right now is we have to look back to the 1979 period, 1978, 79, 80, actually probably 76 through 80, and when inflation was getting out of control. Now, when inflation got out of control at that point in time, it's important to understand inflation hit 13.5% in 1979. 13.5%. So when inflation hit 13.5%, the banks had to do something. So Paul Volcker was the gentleman who was the chairman of the Federal Reserve at the time. And what Paul Volcker did was he took the federal funds rate that was at 6%. So mind you, we're only at, I think, 0.25% right now at the time I'm filming this video. So at that point in time, the federal funds rate was 6%. By the way, the long-term average for the federal funds rate is just about 5%, right? So we are at dire low levels at this point in time. So there's not a whole lot that they can do if we need to lower interest rates. That's where quantitative easing came in. And that's why they started printing money in 2009, because we hit the bottom, couldn't reduce interest rates anymore. We'd been reducing them for 30 years at that time. And so rather than continuing to go into a negative interest rate environment, which would scare the markets and ultimately lose trust in our dollar as the world's reserve currency, they decided to start printing money, right? And as if that wasn't going to have the same effect. But somehow they did it for the last 10 years. They had the ability to keep printing money. They weren't worried about inflation, but now we have this inflation. Now, when we go back to 1979, Paul Volcker raised the federal funds rate from 6% to 19% virtually overnight, right? So it was a 13% bump in a very short period of time, right? And when you look at that, that caused calamity all over the markets, right? But it was a necessary thing to be able to do to rein inflation and get it under control. And because he had the confidence and I'll say the audacity to do that and do what was needed, he was actually the reason that the booming 80s happened, right? A big part of the reason, at least. I mean, granted, there were other things that played into it, but that moment in time, his ability and willingness to do what needed to be done to rein in inflation and get things under control, reset the economy, get to a good place. And that is what was the main kindling for the 1980s booming period, right? So when we look at right now, and this is important to understand, so I'm giving you this history just to understand the market as it was. History has a habit of repeating itself. And where we are right now, we're exactly in the late 70s stagflation-ary type environment, right? Where prices are going up, income's not going up. So while it's getting more and more expensive for things, like houses and food and gas, energy, all that stuff, all the things that we spend money on every single day are getting more expensive, but wages are not keeping up with it. So while we have inflation, we have a stagnation in income. And so we call that stagflation. And that's like the worst scenario all the way around. But when it comes to where we are right now, we still have really low interest rates and we have higher inflation. Now, I think the 7.5% inflation number is actually way lower than it really is. Peter Schiff is a guy that I listen to. If you don't listen to him yet, go check him out. He's amazing. He's a guy I listen to, and he has done calculations showing that if we use the same calculations that they did for inflation back in 1979, we'd actually be over 15% inflation. So he contends that we have worse inflation right now than we've ever had in this country since the institution of the Federal Reserve and this Keynesian economic theory. So it's really, we're in a rough spot. But here's the deal. Why do I think that raising interest rates, this is the long way around, but I think it's important to understand, why do I think rising interest rates are not going to pull down housing prices potentially? Well, it's because the real rates right now are negative. And what that means is the inflation rate, as long as the inflation rate stays at 7.5% or higher, and the borrowing rate is at 4%, that means you're paying effectively a negative interest rate. Because if your money, inflation, and the cost of everything is going, let's take a house, for example, because that's what we're talking about, right? Let's say you had 100,000, I'm going to use a small number just to keep the numbers really round. For every $100,000 in house that you finance, you go get a 4% interest rate, right? That's what it's at right now. So if you know that that house is going to, because of inflation, go up by 7.5%, well, you're going to pay 4% to access money on an asset that you know is going to increase by 7.5%. So the cost of the debt associated with the asset is a negative cost, right? So we call that arbitrage, the spread between what the cost of the money to acquire the asset is. That's arbitrage. So you're able to earn 3.5% arbitrage on this asset. So for every $100,000, you're able to clear effectively $3,500 a year, right? That's just, so for a $500,000 house, you're looking at $17,500 or something like that in arbitrage, in just leveraging your money, right? And so right now, because of the fact that we're having supply issues, supply has never been worse in the real estate market than it is right now. That's the first thing. And that alone is spurring the market up, right? So the arbitrage, the inflation, that concept alone, that is worth it. So housing is going to pretty much keep up with the inflation rate always at a minimum. But then when you stack on top of the fact that we have really, really big supply issues, and people are not building, and new housing starts are really low, and inventory is really low. So it's a complete seller's market, right? They have the ability to pretty much demand whatever price that they want. And I'm not gonna lie, it's tempting. I've been thinking about selling my house because we've gotten so much, but now I'm sitting here going, well, I don't know, because man, you look around, and with this negative interest rate, I can tell you this: if I do sell, I'm going to take my money right around and I'm going to put it into investment properties, because I'm not going to get out of the real estate market right now as long as there's negative interest rates in a real terms. Because don't forget, we cannot just look at 4% and be like, that's the cost. You have to look at 4% compared to the inflation number. And as long as you have a spread there, these rates have to go above the inflation number to make it make sense to not borrow any more than that, right? Otherwise, you just leverage it all day long. And I've been telling people that for a long time, but when inflation is low and the rates go up, then it makes sense. It's going to pull the housing prices down. But as long as inflation stays high, between the supply issues, the inventory issues, and between the fact that we have this positive arbitrage baked in and that real rates are negative, you are not going to see, I don't think, obviously I don't have a crystal ball, but I think fundamentally, we're not going to see any big drawbacks in the housing market until those two issues are addressed. So anyway, hope you found value in that. Hope it makes sense. If you have any questions about any of that, comment in the comment section below. If you haven't already, make sure you click that subscribe button, hit the bell that we get notified every single time I launch a new video. Until next video, have a blessed, inspirational day. We'll talk to you soon. See ya.